Realty Income is one of the most famous monthly dividend REITs in the market. Ticker O has built an entire identity around one simple idea: monthly income. And for a lot of investors, that sounds perfect. A monthly dividend every month feels like a paycheck from your portfolio. But here is the problem. A monthly dividend is nice. A sustainable monthly dividend is what actually matters. So in this video, we are not just asking whether Realty Income still pays monthly dividends. That part is obvious. We're asking a better question. Is Realty Income still the best monthly dividend REIT in 2026? Or are investors buying the story without analyzing the risk? To answer that, we need to look at the business, the dividend, AFFO, debt, interest rates, valuation, and what kind of investor Realty Income actually fits. The biggest mistake investors make with Realty Income is stopping the analysis at the monthly dividend. Monthly payments are attractive, they are easy to understand, they feel consistent. But monthly does not automatically mean safe, it does not automatically mean cheap, and it does not automatically mean the stock is a good buy today. For a REIT, the dividend needs support from real cash flow. That means we need to look at AFFO, payout ratio, debt, interest rates, rent collection, tenant quality, and valuation. Because if the cash flow behind the dividend weakens, the monthly schedule will not protect the investor. So before we call Realty Income the best monthly dividend REIT, we need to move past the headline and look under the hood. That starts with understanding what Realty Income actually is. Realty Income is a real estate investment trust, or REIT. In simple terms, a REIT owns income-producing real estate and passes a large portion of that income to shareholders. So Realty Income is not just a normal dividend stock. It is a real estate cash flow business traded on the stock market. The company owns commercial properties, leases them to tenants, collects rent, and uses that cash flow to support the dividend. For beginners, the key idea is this. You are not buying a store. You are buying shares in a company that owns a large portfolio of leased properties. For intermediate investors, the next layer is lease quality. And for advanced investors, the real question is whether the return on new investments is higher than the cost of capital. That is where the business becomes more interesting. The basic business model is simple. Realty Income buys properties. It leases those properties to tenants. It collects rent. Then it distributes cash flow through dividends. A major part of the model is the net lease structure. In many net lease agreements, tenants are responsible for expenses like taxes, insurance, and maintenance. That can make the landlord's cash flow more predictable. But predictable does not mean risk-free. The quality of the tenant matters. The lease term matters. The rent escalators matter, the property type matters, and the price paid for the property matters. So the business may look boring from the outside, but the analysis cannot be lazy. Realty Income works when the rent engine stays healthy, the balance sheet stays disciplined, and new investments create value. Now let's talk about why investors love it so much. Realty Income became popular because it gives investors a very clean story. Monthly dividends, a long dividend history, a large property portfolio, a simple income-focused identity. And for many income investors, that combination is powerful. It feels stable. It feels understandable. It feels like a business designed for people who want cash flow instead of hype. That is exactly why the stock gets so much attention. But popularity is not the same thing as future returns. A company can be loved by dividend investors and still be overvalued. A stock can have a strong history and still face pressure from interest rates. A dividend can be reliable and still produce disappointing total returns if the price is wrong. So the brand is strong, but the numbers still matter. The monthly dividend story is real. Realty Income announced another dividend increase in 2020 fixed, raising the monthly dividend to 27.1 cents per share. That equals $3.25.2 annualized. For income investors, that kind of consistency is exactly why the stock is popular. It creates a rhythm. Every month, shareholders receive income, and psychologically, that matters more than people admit. But here is the critical point. Dividend history is backward-looking. It tells us what the company has done. It does not automatically tell us what the stock will return from today. The future depends on cash flow, payout ratio, debt, interest rates, acquisitions, and valuation. So the dividend history deserves respect, but respect is not the same thing as blind trust. Now we need to follow the cash flow. For REITs, AFFO is one of the most important numbers to understand. AFFO stands for Adjusted Funds from Operations. Without making this too complicated, it is a cash flow-focused metric that helps investors understand how much recurring cash the REIT may have available after important adjustments. That matters because traditional earnings can be messy for real estate companies. Depreciation and accounting rules can make net income less useful by itself. So when analyzing Realty Income's dividend, the question is not only what is the dividend yield, the better question is how much AFFO is supporting that dividend. If the dividend grows faster than AFFO for too long, the payout can become stretched. If AFFO grows steadily and the payout ratio stays reasonable, the dividend has more room to breathe. That is where payout ratio enters the picture. In the first quarter of 2026, Realty Income reported diluted AFFO per share of $1.13. The dividends paid during the quarter represented 71.7% of that diluted AFFO per share. That is important because it gives us a sense of dividend coverage. A payout ratio below 100% means the company is not paying out every dollar of AFFO as dividends. There is still some room for reinvestment, debt management, and flexibility. But this does not mean the dividend is risk-free. It simply means the dividend coverage looked manageable in that period. For investors, the job is to monitor whether that coverage remains healthy over time, because one quarter does not make a full thesis. The trend is what matters, and the trend depends on growth, debt, rates, and property performance. Dividend yield gets the attention, but yield is not the whole story. A high yield can mean the stock is attractive, or it can mean the market is pricing in risk. That is why yield by itself is dangerous. With Realty Income, investors need to connect the yield to AFFO, payout ratio, debt, interest rates, growth expectations, and valuation. If the yield is high because the stock is temporarily unpopular, but the business remains strong, that can be interesting. If the yield is high because the market sees pressure on cash flow, financing costs, or growth, that is different. So the smarter question is not how big is the dividend. The smarter question is how strong is the engine behind the dividend. And for Realty Income, that engine is real estate scale, rent collection, and disciplined capital allocation. Realty Income has scale. At the end of the first quarter of 2026, the company reported more than 15,500 properties and more than 1,700 clients. That scale can be a major strength. It reduces dependence on a single property. It reduces dependence on a single tenant. And it gives the company a large platform for rent collection and acquisitions. But scale has two sides. A bigger portfolio can create stability. It can also make fast growth harder. When a company becomes very large, it needs larger acquisitions to move the needle. Small deals may not change the overall picture much. So Realty Income size is part of the quality story, but investors should not assume that a bigger REIT automatically grows faster. Scale helps durability. Growth still has to be earned. The rent engine is what supports the dividend. That means tenant quality matters, lease terms matter, occupancy matters, rent escalators matter, property type matters, sector mix matters. If tenants are healthy, leases are long, occupancy stays high, and rents can rise over time, the REIT has a stronger foundation. But if tenants weaken, financing gets expensive, or acquisitions become less attractive, growth can slow. This is why Realty Income should not be analyzed like a bank account. It is a real business, and real businesses have moving parts. The dividend starts with rent. Rent depends on properties and tenants, and the value of that rent stream depends heavily on interest rates. So now we need to talk about the biggest pressure point for REITs: rates. Interest rates matter a lot for REITs. When rates are higher, debt can become more expensive. Treasury yields can become more competitive. cap rates can shift, and REIT valuations can come under pressure. For Realty Income, this matters because growth often requires capital. The company may use debt, equity, or retained cash flow to buy more properties. If capital is cheap, acquisitions can be easier to make attractive. If capital is expensive, the math gets harder. This is why a REIT can be operationally strong and still have a stock price that struggles. The market is not only looking at rent collection, it is also looking at the cost of capital and the yield investors can get elsewhere. That leads to an important comparison: Realty Income versus Treasuries. A Realty Income dividend is not the same as a Treasury coupon. That distinction matters. Treasuries are fixed income backed by the U.S. government. Realty Income is an equity REIT. It owns real estate, trades like a stock, and carries market risk. That means the dividend may be attractive and the stock may still fall. The income can grow over time, but the share price can move against you. Treasuries may offer less upside, but they also serve a different role. So investors should not compare Realty Income to Treasuries only by looking at yield. They need to compare risk, duration, growth potential, volatility, and purpose. Monthly income does not mean risk-free income. Realty Income can be a strong income investment, but it is not a bond, and it should not be treated like one. Debt matters because REITs are capital-intensive businesses. Real estate is expensive. Growth requires funding, and funding has a cost. For Realty Income, investors should pay attention to debt maturities, interest expense, credit profile, capital access, equity issuance, and balance sheet discipline. A strong balance sheet gives a REIT more flexibility. A weak balance sheet can turn a dividend story into a risk story very quickly. This is especially important when interest rates are not near zero. If old low-cost debt matures and new debt is more expensive, pressure can build. So the analysis cannot stop at the dividend. It has to include the capital structure, because a REIT can only grow well if its capital cost makes sense, and that connects directly to acquisition spreads. For Realty Income, growth is not just about buying more properties. It is about buying properties at the right spread. Here's the simple version. If the company can acquire properties at returns above its cost of capital, those deals can create value. If the cost of capital rises too much, attractive acquisitions become harder. That is why interest rates, share price, debt costs, and acquisition yields all matter together. This is the part many dividend investors ignore. They focus on the monthly payout, but the future dividend growth depends on whether the company can keep investing profitably. Realty Income size gives it access and reputation, but every deal still needs to make economic sense. So the key question is not just, can Realty Income buy more properties? The better question is, can it buy them at attractive spreads? Before we move into valuation and the final verdict, this is the kind of REIT analysis we focus on at Boring Money Wins. Not just dividend yield, not just monthly payments, not just brand reputation. We look at cash flow, payout safety, interest rates, debt, valuation, and the actual investment thesis. If this kind of no-hype income investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want analysis instead of noise. Now that we understand the dividend, the rent engine, the rate risk, and the debt picture, we can ask the market question. Is Realty Income still attractive compared to other choices? When investors compare monthly dividend REITs, they often look for the highest yield. That is understandable, but it can be dangerous. The best monthly dividend REIT is not automatically the one with the largest yield. A big yield can hide big risk. The smarter comparison looks at dividend safety, AFFO coverage, debt quality, portfolio quality, growth potential, and valuation. Realty Income may not always offer the highest yield in the REIT market, but it may offer a combination of scale, history, diversification, and predictability that many smaller REITs cannot match. That is why the comparison needs balance. A higher-yielding REIT might look better at first glance, but if the dividend is less safe or the balance sheet is weaker, the extra yield may not be worth the risk. So what may Realty Income offer that keeps investors interested? Scale, History, diversification, monthly income, REIT experience, and strong investor familiarity. Those are real advantages. A company with a long operating history and a large diversified portfolio can be easier to understand than a smaller, riskier income vehicle. That does not mean Realty Income is always the best buy, but it does explain why it remains a core name in the monthly dividend REIT conversation. For many investors, the appeal is not maximum yield, it is confidence in the business model. But confidence should still have a price limit. Even a quality REIT can become a mediocre investment if bought too expensive. That brings us to valuation. Price still matters. This may be the most important part of the video. Realty Income can be a high-quality REIT and still be a bad investment at the wrong price. Investors should look at price to AFFO, dividend yield compared to history, growth expectations, treasury spreads, debt quality, and margin of safety. If the stock price is too high relative to growth, future returns can disappoint. If the stock price is too low because investors are overly pessimistic, the opportunity may be better. As of July 1, 2026, Realty Income was trading near $61.82. That price alone does not tell us whether it is cheap or expensive. The price has to be compared with cash flow, dividend growth, rates, and risk. Quality is only one side of the equation. Valuation is the other. This is where investors need thesis discipline. A strong company is not always an automatic buy. Realty Income may have a strong brand, a large property base, monthly dividends, and a long history, but the stock still needs to make sense at the price offered by the market. Company quality and stock valuation are related, but they are not the same thing. A great company can be fairly priced. A great company can be overpriced, and sometimes a hated company can be cheap for a reason. With Realty Income, the investor has to separate the business from the stock. The business question is, does a Realty Income remain a high-quality income REIT? The stock question is, are investors being paid enough for the risk at today's price? Those are two different questions. So who may still like Realty Income? Income investors, long-term holders, investors who want REIT exposure, investors who value monthly cash flow, dividend-focused investors, and people who understand that an equity REIT can be volatile. Realty Income can make sense for someone who wants exposure to commercial real estate cash flow without directly owning properties. It can also fit investors who want a more predictable income-oriented holding inside a diversified portfolio. But the key phrase is diversified portfolio. Realty Income should not be treated as an entire retirement plan. It should not replace cash. It should not replace bonds. And it should not be bought only because the dividend arrives every month. It can be useful, but only when the role is clear. Some investors should be careful. If you are only chasing yield, Realty Income may tempt you for the wrong reason. If you need short-term cash, the stock price volatility may be a problem. If you have low risk tolerance, you need to remember that REITs can fall. If you ignore interest rates, you may misunderstand the valuation risk. If you ignore debt, you may miss one of the most important parts of the REIT model. And if you expect Realty Income to behave like a bond, you may be disappointed. Monthly dividends do not remove market risk. Realty Income can be boring, but boring does not mean risk-free. And the difference between those two ideas matters a lot. That is why the final verdict has to be balanced. So, is Realty Income still the best monthly dividend REIT in 2026? The honest answer is this. It is still one of the most important names in monthly dividend REIT investing. It has scale. It has history. It has a clear income identity. It has a business model that many investors understand. But it is not automatically the best buy at any price. It is rate sensitive. It depends on debt and capital markets. Its growth must be earned through smart acquisitions, and its valuation still matters. So, for investors who want quality monthly income and understand REIT risk, Realty Income can still be relevant. But for investors chasing the highest yield or expecting bond-like safety, it may not be the right answer. The dividend is strong. The analysis still needs discipline. Realty Income is a good example of what this channel is about. Boring can be good. Monthly dividends can be useful. Reliable cash flow can build wealth. But boring income still needs serious analysis. You cannot just buy a dividend story and ignore the numbers. You need to understand cash flow, risk, debt, interest rates, valuation, and whether the investment fits your actual plan. The dividend is boring. The analysis cannot be lazy. That is the lesson. Boring money wins when boring money is bought with discipline, not because the stock pays monthly, not because the brand is famous, but because the investor understands what they own, why they own it, and what could go wrong. That is how boring money survives. And boring money usually wins.